All right. Good morning. Good morning, everybody. ADP, PMI, and ISM manufacturing today. We also have a lot of Fed speakers. I'm not seeing it on here, but Bloomberg said they were going to interview one of the Fed speakers at 8:30. So looking at what happened overnight in Asia, inside day breakout, they did manage to rally back up, close inside day, which gives them 4 days in a row now. 5 if you count the run-up day. So their IX10 running pretty stable underneath that level. Japan, inside day breakout, closed near the low of the day, closed a couple of gaps. This one, not really too much of a surprise, just they didn't get a chance to recover at all. And for Europe, really muted so far. It's 12:30 over there, so they still have a little bit of time left. But really nothing. Looking at, the previous run up, the size of these candles and the size of their trading range today, there's really nothing much. So that move in gold yesterday was really tied to US dollar Japan going down. It's like a inverse product. And then it just picked up speed and really took off. Pretty phenomenal, really. If you're in gold long or silver or any of those precious metals, really keep an eye on US dollar Japan. If it stabilizes, catches a bid, and moves to the upside, gold's going to come under pressure. So Bank of New Zealand surprised the markets and raised by 0.5 point. Markets don't like surprise, so that's a little bit of the reaction we've seen in the overnight. We do have crude inventories today at 10:30. So if you're watching USO at around 10:30, it can oftentimes give you a small intraday trade. So we can see ISM manufacturing today at 10:30 is normally a very impactful data point. It's highlighted in a darker orange. Very likely today won't be an exception, right? It'll be it's anticipated to be important. And of course, the continuing job data, right? All week this week, the job data is going to be important. You can see ADP up here, also bright orange. And European Central Bank Lane, this person, might want to check on their speech. They've been known to, shake the markets a little bit. spot gamma levels for today. Just grab a screenshot of that. Now, once we get through the energy report at 10:30, you're pretty much good to go for the afternoon. So 0-day trades this afternoon shouldn't have any impact from, outside sources unless somebody gets out there chipping teeth. Someone that's not yet in the list. We can see volumes a little light this morning, not as light as I would have anticipated with the econ that we have on deck, but less than 100. It's not really a surprise. We keep track of this for those days where, there's nothing really on the docket for a pre-market. And then we also suddenly see, a really high volume or a really low volume. But we have things on the books today, and we can just get that out of the way. All right, so the market looked like it was going to try an inside day breakout in the overnight hours. It didn't do it. Came down close. Hasn't even tested that low yet. A little bit of a shakeup through the kill zone, but really it's just hugging VWAP. So we've got nothing this morning. A lot of times we talk about trading inside a trading day, right? Looking left, seeing if we're still inside yesterday's price action. Right now we're inside of that afternoon range. So that's going to give you a zone all of its own. We're inside our own Globex, inside of that afternoon range. Now it's built up enough levels that this is the zone you have to get out of first. Then to the open of yesterday, and then to the high of yesterday. It's 3 different zones if you're looking for a recovery back up through all that mess. Added along the way with a daily pivot point, which we haven't hit yet. So we've got an MDP and we're underneath it. And getting back through the previous week's high. We can add to this also the Globex low of yesterday, which gives you another zone. There's less risk for a downside move than there is for an upside move at this point. Right. So, if we were to talk about probabilities, what's more likely? That the market runs nearly 5%, pauses for 1 day, and then yet again continues an upside move for more than that? Or that we continue to pull back and say, get at least half of this retraced? Well, I'd say it's more likely that we continue to pause here and or pull back from here, at least a little bit. So that's what they talk about with risk to reward, that it's not an appropriate risk to reward. Just honing in on that what's more likely question. So we're stabilized right on the edge of an air pocket. If we break yesterday's low, we will come into that air pocket, and there's nothing really to help us out until we get down to around 40.80, 40.70 is, yeah, 40.70, 40.80. And there's not really a whole lot there, right? There's a little bit. Could be, say, a first touch bounce or a pause. Then we slip back into another air pocket, and there's nothing until 40.50. So we're right on the edge of making a pretty good size move to the downside. We traveled through that area, moving up really fast. We didn't leave much of a footprint behind. So it's very likely that if we were to travel back through that, it'd be the same thing, right? Because there's not really a lot of restrictions to hold us back, as opposed to the upside move, which has nothing but resistance all the way back up through that zone. 5-day, 5-minute volume profile. We can see how that first touch comes into effect yesterday when we hit the VPOC. And it didn't even slow it down this time. We hit it, went right through it, but we did stabilize underneath it. Of course, those levels are done now, and the other VPOC was down here, and that actually set the low. Of course, we wicked through it, but those two VPOCs are now off the table. We're done with them. We don't have one from yesterday because we've already crossed through that area multiple times. So the next one down is 40.43. It's a long ways off. It would be a part of this volume cluster here. Now, I mentioned yesterday in the morning briefing that since we were going to be opening higher instead of lower, that I actually had a bearish bias, but that I hadn't expected us to actually dump down. And we didn't. We stabilized, we held, we really didn't go anywhere. And it was all a part of the same idea that, there's plenty of books that talk about it, but Grimes kind of goes into it a little bit too, where in the overnight hours, they talk the market down, make it sound, bad, a bunch of negative reasons why you wouldn't want to go long. And then come into the market gapped down, trap some bears, and run it up. If you look at it from a daily chart, it makes sense, right? Because the market, we don't want it to go straight up. We want it to pull back. So how do they get these pullbacks? In the overnight, they're putting out articles talking about how bad it is, blah, 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 pulling it back a little bit in the pre-market so that we get that next leg up with a pullback. So when we kept opening up down in this run up, it fits that argument. Except yesterday, that's not what we did, right? Yesterday we opened it gapped up. But I don't think that's the one. I'll be wrong if we break, say, 41.11 and start heading back down through these zones, but I don't think we're there yet. So we're going to treat this the way that we have it for right now. That we have a market in a trend and that we have a mild pullback with an expectation of continuation until at least this high set back in February. And if we zoom out, we can see there is another level beyond that if we need it. I don't think we're going to need it. 43.30, just round up a little bit. It's possible that we end up using that level, but I don't think so. So right now, all we have is a pullback. And until we at least break the low of April 4, I wouldn't bear up, right? We got to at least break that. All right, so you can see a large part of the move yesterday was with finance getting whacked. But if you look at the mega market cap names, say the FANG names, they really didn't take that much of a beating. This kind of goes to that argument that I'm making that we're only looking at a mild pause in this move to the upside, and that there's very likely still more move to the upside. So it's something to keep in mind, right? Look for that flip in the market where we kind of throw off this negative bias. It's not even bearish. It's just kind of laissez-faire, right? Just we're looking for the market to, what they say on Bloomberg, like the animal spirits. Where's everybody at, right? Where's all the traders? Where's the enthusiasm and FOMO and momentum? That's what we're looking for. So we've got Bitcoin ETF up this morning, nat gas, and that's about it. We're even getting a little bit of a follow through with gold, which is nice. But it's not enough yet to hit the radar. And bonds aren't down. They're not up, but they're not down. All right, so here's the ZN. We go a little farther out if we want with like the ZB, or we can come in a little closer, say with the ZF. It's a pretty wild scoop. But we're not back up to the top, and we're through any of the critical levels. We're still looking at, bonds making some big moves to the upside. So the anticipation is we're going to continue to see the 10-year, the 2-year move to the downside. All right, so through this move up here in the ES, started, like say back here on that Tuesday, we started making that run up. That's where Tuesday we topped out in the 10-year, kind of went sideways for a few days, so we weren't getting any pressure here. And then it started heading to the downside. That's when we really had that breakout day on Friday. So when this started to break down, now that we're stabilizing, we're seeing a little bit of that pullback. Yesterday, we had a pullback in the ES and we had a pullback here in the 10-year. I mentioned before how they'll sync up because they're working, say bonds up, stock down, stock up, bonds down. So it makes sense when we're going to see things like the ES and the 10-year moving together, but only to a point, right? Because if the 2-year or the 10-year in this case, if it goes too far, it's going to decouple from the ES, either too far to the downside or too far to the upside. So we want to watch for that decouple this morning. We can see a little bit of it already. They both made that big move to the downside yesterday. Through the pre-market this morning, the 10-year is pushing against the low, like it wants to continue the breakdown, and the ES is making a move back up. It's already through the VWAP and is trying to get back up to where we opened last night. So they're starting to decouple a little bit. We want to see this gulf widen more, right? Like say the 10-year actually break down below yesterday's levels and continue to move down, which would be seen as a deflationary event. Not an event, that's the wrong word. Yeah, take that word out. Or it holds here and it continues to chop around, maybe start making waves, pushing back to the upside. A little bit of mean reversion after this drop. All right, so if you look at the front end on the bonds, we're looking at the 5-year right now, the ZF. A little bit of weakness in the overnight, coming back up for an inside day breakout. Maybe go a little farther out on the curve, 30-year here with the ZB. It's not just an inside day breakout. We're also looking at Friday, 24th of March. So we take that out to this bigger daily chart, and you can see that it becomes a pretty big deal. If we get a big move to the downside today, say it rejects off of these highs or off of these levels, that should be a nice tailwind for the S&P to rally, right? For that continuation of the move higher in the S&P. So that's kind of what we want to look for today. Is the bonds going to break out of this zone that it's been in and finally get this push to the upside? Or are we going to reject again and maybe retest that 129, look for a breakdown, back to these lower 120 levels? If you see how we've been setting and pulling back and then setting and pulling back, that's not what we're doing now. Now it's this continuous drive pressing against this zone, and all of this liquidity is slowly getting taken out. Notice we're not getting these big wicks and pullbacks. It just keeps pushing and pushing, and it's about to get through there. So if the sellers are exhausted here and they don't defend this level anymore, or there are no big sellers left because they've already gotten rid of their holdings, their liquidity, it's an open shot for a push through here. We got to think about what a bond breakout would look like. What's it going to look like? We get above 133.5, say 134, into the 135 area. So that on the bigger picture is worth watching today. Keep your eye on the bonds. Look for this change in structure. That we get a definitive smackdown off of this zone with a really clean pullback, which should give the S&P a lift, get us at least back to yesterday's high, and look for an inside day breakout to the upside in the S&P today. Otherwise, we break the low. We want to aim for the weekly pivot point, maybe the ATR first, 40.98, which is like go for 4,100. And then 40.87, which is the weekly pivot, and a full ADR at 40.62. Even pulling back that much is still holding above the 50% level of this run. So in the bigger picture, we would still maintain our bullish bias and not try to run short on the rest of the market. All right, so we're basically flat this morning. We got nothing out there. Semiconductors down more than 0.5%. But really, I mean, that's all we got. All right, so there was the move in GLD yesterday, if you hadn't caught it. And the move in silver yesterday. Kind of the reason for the move, or at least the start of it. It kind of took off and had a life of its own at some point. All right, so gold's holding up better than silver is this morning. If you're looking for a continuation, you want to be really careful, considering how far we stretched up there, especially over the last, say, 5 to 6 days, right? From 168 to 188, that's a run. That's kind of getting a little bit the wild side there. Big liquidity zone. And we're coming up into that now. And it matches this unfinished zone from back here. That it's still not done, right? This is why the word unfinished is in there. So if you're long gold, you've got a lot of resistance coming up, some significant levels of liquidity that need to be worked through. And after the run we had, pretty safe bet that, you know, exhausted or maybe overbought. I really want to use that word, but exhaustion comes to mind. So some call credit spreads against these highs, that's looking like a pretty good trade. You know, the spread's not that bad either. Kind of thought it would be worse than that. So you got $1 wide strikes and 10-cent wide spreads. That, I mean, I'm impressed, I gotta say. The calls certainly have more liquidity than the puts, at least in the May series where I'm looking. May or June, I don't think there's too much difference between these two. Looking at liquidity, if we were going to bring in, you know, get all nerded out, looking at the stats, looking at the Greeks, that'd be a different discussion. But say something cheap. First, let's just get a ballpark on their price. So a $1 spread at the money should be around 50 cents credit. And that's what we're seeing for June. $1 at the money should be 50 cents in credit. And that's what we're seeing in May. So, you know, the market's closed. These prices aren't accurate. But if it was really out of line, then this credit would have been something like 35, maybe 37 cents. And that would have been an inappropriate trade. We would know, all right, that's not good. We don't want it. But the levels are respectful, fair. So here I've got a 51 and a 39 delta. Let's just kind of throw this over to the Analyze tab real quick. Yeah, that's not too bad. A little bit of delta. I'm out of the money, so it's risking more than it's going to make. And you wouldn't want to run it all the way to expiration. We're talking about a short duration trade, maybe 35 to 50% profit. The break even on this is gold would need to get below, stay below, close below 191.81. So, you know, price can go above that, chop around, take that rejection that we were looking at. As long as it gets back down below that level, this trade is still good. If it doesn't, if it gets up, even if it just gets to that level, this trade's going to be under pressure. But if it gets above it, then you know, you'll want to roll it, close it, manage it in some way. If it gets above and doesn't look like it's going to come back down, right? So say gold takes a big leap through this zone and gets into like 205, 212, it's not coming back. There's no reason to hold that trade. But if you're watching it through like an intraday and gold pushes up through that 190, 110, gets into say 192, don't just freak out, close the trade as a loser. Because we're looking for it to finish this move, take a rejection, and begin pulling back. I know the out of the money stuff is what people like. Personally, I like things that are at the money. Something that, you know, say $4 wide with $2 credit. It's a risk one to make one. It puts your break even basically at the money. And this is a trade that you can turn into a legged in iron condor a lot easier than that one that's out of the money. You can leg into the one that's out of the money. Don't get me wrong. You can turn that into a legged in iron, but to get it a risk-free legged in iron, it'd be almost impossible to do. Whereas with this one, getting this one to be risk-free, where you're just holding this credit spread and you have no risk to it at all, it'd be a lot easier to do. All we would have to do is see that rejection and get that pullback and then let it find support somewhere, say in the low 80s here, or maybe even in the 70s. Once it finds support, looks like it's not going to continue to fall. We could put on the put side, also at the money. And in this example, since I went $4 wide, go 4 wide again for $2 credit. And there's your completely risk-free trade. It either closes inside of that iron condor and you make $2, or it doesn't and you lose commissions. Not a bad trade. All right, liquidity proxies like Bitcoin kind of help out a little bit. So we're looking at Bitcoin with this really big bar here. And then multiple weeks where we've just been struggling, lots of indecision candles, lots of dojis. It doesn't want to fall. It doesn't want to rally. Really keep your eye on this thing. I'm looking at it on a weekly just to show you we're in this topping pattern here. And we got a lot of resistance, say at 29. But just like when we were looking at the bonds and having that discussion of a big bond move rejection today down away from the highs in bonds will give the S&P that little bit of lift, maybe a boost to the upside to break us through yesterday's levels. Well, the same thing here. If you use this for just a proxy, a breakout and a continuation to the upside in this is like a risk on for the rest of the market. If this is bullish, we would expect other risk assets to be bullish. And then it kind of bleeds over into everything else. So since this is topped out and we've just got this big cluster of trash, we're looking for a resolution of this, either a solid breakout above 29 or a legitimate drop back down to these lows, and then a real breakdown. So there is a candle that you can focus on. March 22nd would be the day there. That's the boss. All right, that's a solid breakdown on NVIDIA. Closed at 274. Right now we're at 270. We have a gap to close from the 29th, and then one more gap to close on the 28th. So after this big gap down this morning, I would stress a little bit of caution, right? Look for a red day like this, that doji day. So if we open gapped down and say close this gap, and then we get that rally rebound and it gets near the open of today, maybe a little higher than that, and we end up with one of these doji candles. Two red days in NVIDIA does not bear us up, right? This thing has been a monster this year already from 2023. Almost 50%, 49.82. Come on. There it is, 50.35. So I wouldn't look to short this sucker for some big short. We don't have that yet. You can, bear up a little bit for the intraday, get a little day trade on it, but I wouldn't try to get more than that out of this thing yet. You would want to get below 260 if you're going to try to short this sucker for like a swing. But today might offer an opportunity for a put credit spread at the money if we can, stabilize, get that midday reversal like we had on Monday. A nice little midday flip. That didn't work for people that got in on Monday with a credit spread. They're getting run over right now. But what we're talking about is a retest of, say, 265, maybe 264. Let it continue to get weak this morning, break these levels, and then turn back up. If we can get to 260, that'd be a nice LRE, right? Low risk entry off of 260, 259, 260. That was a pretty decent move in Tesla the other day, right? When they had that news come out, took Tesla down, took NIO, a lot of the other EVs. But this is just like NVIDIA at the, we come out to the daily and the weekly. It's not in a position to short it as a good swing. Day trades, maybe short duration trades, in today, out tomorrow, in today, out Friday. But, if you're thinking you're going to run this sucker back down, not yet. So it's up in the pre-market. We want to see it resolve yesterday's level. A break down below 190, which would be, say the low of yesterday, just say it that way. Then we can target this gap close here, 189, and say the low of this candle. That's March 28th low, 186. It won't be a straight shot, and it won't be easy. So if you're going to try to short Tesla underneath yesterday's low, below that 192, it's going to be a fight, right? But 188 would be the next level. And I'm not bearish. I know it might sound like it because we're talking short on all of these, but all right, so we're continuing that split from yesterday between finance and tech. Finance is down again this morning. Tech's not really all that down compared, right? If we're to measure the two. So we want to see finance at least quit the downward move. It doesn't necessarily have to rally with us, but it needs to quit going down against us. That would be one of the things that I would look for today. It's going to open probably away from that VWAP. Open gap down. So we're going to want to see KRE at least get back up to the close of yesterday. And then, of course, we got econ today, right? So charts being one thing, we still got to get through the econ. So that's why I got, be careful, be safe. Keep your eye on the bonds today. I think they're going to be a big tell. Right. I'll see y'all tomorrow.